everybody. I'm Jerry Cronenberg, Director of Financial Content here at Moomoo Technologies, and I'd like to welcome you to our latest webinar with the man, the legend, our markets commentator, Stephen Sarge Guilfoyle. Steve, good morning. How are you today?
Good morning. I'm fine. How are you, Jerry?
I am just fine, thanks. So we're talking about the Federal Reserve today. As we speak, the Fed is beginning a two-day policy meeting today. We will hear tomorrow what it's going to do with interest rates. And we're going to talk to Steve today about stock, bonds, and options trading in and around the Federal Reserve meetings. Now, we're running this meeting, as we said, ahead of the Fed meeting, but this is an interactive video, and we'd like to encourage you to answer some questions or ask some questions for Steve to answer. Use the chat function below to send your questions in now. If we use your question, you'll get 1,000 Moo points, and even if you submit one, you'll get 100. Now, for those of you who don't follow the Fed that closely, the Federal Reserve does set monetary policy for the United States. That is interest rates. It is trying to balance inflation and unemployment to fine-tune the economy. Now, stocks, treasury bonds, options, and more can and sometimes do move, and sometimes very wildly, depending on what the Fed says and does in its communique after its meeting, what it does with interest rates, and especially what happens when the Federal Reserve Chairman gives a presentation, a press conference every day. We're going to get the Fed statement at 2 o'clock Eastern Time, New York time tomorrow, and we're going to get the Fed press conference at 2:30 p.m. And, of course, you can follow those things at Moomoo Technologies. Now, Steve, of course, is here to help you learn about investing of all facets. He is a former New York Stock Exchange floor trader. He is an economist. He is a columnist for the Street.com Pro. And most importantly, he is on Moomoo every trading day under the Invest with Sarge handle in the Moo community. And he is here to give you some thoughts on the market and to try to answer your questions and help you out. While he cannot give you personalized investment advice or recommendations, he can tell you what to think about in your investing journey. So check him out there. And by the way, his name is Sarge. His nickname is Sarge because he's a former U.S. military sergeant. So we're going to wait for some questions, but let's get talking while we do that. Now, Steve, the FOMC, not everyone really understands what that is, what it does, how to position their stock and other portfolios around that. Why don't you talk about that and talk about, is there any historical pattern? We can't predict what's going to happen tomorrow. Any historical pattern with what stocks, bonds, options, and the like do in and around Federal Reserve meetings? What are your thoughts about that?
Yeah, well, the FOMC is the committee of Fed officials at the central bank that sets monetary policy. So they're basically the most important folks at the Fed right now. There are an army of hundreds, maybe, of economists at the 12 different branches that support their work and put out research of their own in the form of white papers and things like that. They also provide models for GDP, for inflation, and other economic data that we can follow along and then see how accurate they are. Like Atlanta Fed is very famous for their GDP model, although they really weren't the most accurate one for the first quarter this year. I think St. Louis had the most accurate model of all the models this quarter. But for some reason, we follow Atlanta because we've always followed Atlanta. Maybe they were first, but St. Louis was the more accurate one this time. And basically, this committee, it's comprised of 5 Fed presidents on a rotating basis, except for New York. New York is a permanent member. Along with the Federal Board of Governors. They're all permanent members, and they provide for us a guide path in the form of short-term interest rate control, really, well, targeting, and they try to also impact liquidity or the monetary base through both quantitative easing and quantitative tightening, or a hands-off approach, which we haven't seen in a while.
Okay, great. And what typically happens now, we're the day before the Fed meeting, or I should rephrase that, it is a 2-day meeting. So we're at the first day of the meeting. The actual public activity will happen tomorrow after the meeting is over. But what historically happens with the stock market, the bond market? Do they only react the day the decision comes out, or when the decision comes out? Does there start to be a reaction even today? If right now, everyone is waiting to see whether the Fed will cut rates. That is the expectation rather than raise rates. Unclear whether it's going to happen today or later in the year or not at all. Let's talk a little bit about that. Bonds historically, what do they do in an era where we are now, where we're looking at potentially cut? What do stocks historically do? Why don't you talk a little bit about that for people who are not familiar with those things?
Well, stocks and bonds will both trade more quietly on the Monday and the Tuesday, and for most of the Wednesday when there's a Fed meeting on a Fed the result of a Fed meeting on a Wednesday afternoon. So yesterday was kind of quiet. It wasn't as quiet as I expected it to be, but it was kind of quiet. I would think today, outside of earnings, because we got a lot of earnings today here in the U.S. I think we had Lilly and McDonald's and a couple of other ones this morning. We have Advanced Micro Devices and Amazon and a few other important ones this evening. So you might see volume pop around that has nothing to do with the Fed. But overall, I would expect a quiet day today, a quiet morning and early afternoon tomorrow. Then the Fed releases their statement, which is usually a cut and paste job, maybe not too many changes at 2 p.m. here on the East Coast of New York, of the United States. And there may be a change in the wording, maybe not. It takes, usually there's a pop one way or the other in the marketplace right at 2 o'clock because the keyword reading algorithms will move the market a little bit. There'll be a knee jerk that isn't always right. So in fact, it's often wrong. And then you'll see a little bit of a lull in trading because now the humans are reading the statement, they're reading the material, and they're trying to catch up to the algorithms. So, and they're also waiting for the 2:30 for the half an hour later press conference, which is run by the chairman of the Federal Reserve. In this case, it's Jerome Powell. And there you will often glean more information than you got in the statement because Jerome Powell will try to maybe guide the message he's trying to send out to the public in terms of economic growth, in terms of inflation, in terms of what the Fed is thinking of going ahead with rate cuts as they were earlier this year, or maybe they're backing off that stance. We'll get a lot more color on what the Fed is thinking in his press conference and in the way he answers the questions from the media than we will from the statement. But the statement kicks off the festivities.
Great. We're getting some questions in. Keep sending them in. We'll take some live ones soon, but let's continue on this discussion. So 2 o'clock New York time, we're going to get the Fed statement. We'll have it here at Moomoo. It's typically 200 or 300 words. As you said, it doesn't change that much from meeting to meeting. The Fed meets about every 6 weeks or so. But you talked about the human. So when you read that statement, what are some things to look for? Obviously, the first thing is they're going to say in some instances, not widely expected this time, we've decided to raise the federal funds rate or lower the federal funds rate or keep it the same. They will say actually one of those three things. So that's a key thing to look at. But it's parsed almost like the Bible, that there may be one or two little changes. So what do smart investors, professional investors, what sort of things are you going to look at in that statement?
Well, I'll tell you what I do. When 2 o'clock rolls around, I will already have my printout of the last two statements in front of me, and I will review what changed from two statements that go to the last statement, and I will have my highlighters ready, and I will change even if it's just one little word, any change in the statement, I will highlight as I go through the statement word for word, and I will decide for myself before I look and see what other people are doing. I will decide for myself if I think that impacts my thoughts on the market. Then I will look to the bottom of the page and I will see if there were any dissensions, because I like to know if everybody's on board with the decision or if maybe one or two people are thinking for themselves, which we don't see too much of anymore. Pretty much, I think they decide to come to a consensus these days and then vote as a block. But in the past, we did see times where one or two members of the committee would say, I think something else. This is what I think. And they would note that at the bottom and in the footnotes at the bottom of the statement. So those are the things I kind of look for. And if there is dissension, I think it weakens whatever message the statement is trying to send.
Okay, great. And let's ask a little bit about the famous dot plots. That's something you hear a lot in the media. Well, the statement came out, but the dot plot showed this or that. Talk a little bit about what that shows you and what that is.
Yeah, I think the dot plot was really a mistake. I think the forward guidance was really a mistake by the Fed. I think the intention was solid. I understand why they wanted to provide forward guidance on monetary policy, but it has really turned out to make the group as a whole look really poor, I think, since its inception, because they have proven to be as lousy at predicting the economy going forward as the rest of us. And so therefore they're projecting their thoughts on interest rates, on unemployment, on inflation, based on GDP levels or employment levels that probably won't turn out as the median projects, because there's always outliers, and the dot plot will show you the outliers. And then when you see the dot plot for itself, you'll see that, what do they got? I think they have 15 or 16 voters. You'll see that three or four of them are completely out of their minds because they will project like a GDP that's totally out of line with whatever monetary policy message they're trying to send. So it really, I think, has weakened the credibility of the Fed. Although I don't think they've completely lost their credibility. I'm not saying that, but it has weakened the credibility of the Fed to provide this dot plot. And I have suggested to them time and time again, they don't listen to me anymore, but I have suggested to them time and time again to drop the dot plot, as I think it just really makes them look inefficient as a group. And if you look back to the past before, let's say, I guess the Ben Bernanke era, really, we only heard from the Fed when they did something, and we got very little information. Maybe that lack of transparency wasn't really good, but this is the other extreme. The minutes provide too much information now. The dot plot provides too much information. I think we need a little less of that. And we need less speakers. I know I'm going off on the rails here, but you'll see after this statement, maybe they'll take a little bit of a break on Thursday, but on Friday they'll start pounding us, because if the market reacts in a way that they don't like, or weren't intending to see, to the statement and the press conference on Wednesday, there will send down an army of Fed speakers to try to either reinforce Powell's message or to change the narrative, because the narrative is going the wrong way. So I kind of preferred it in the old days, where you knew who the Fed chairman was and you really didn't know the names of anyone else. But that's neither here nor there. That's not the way things are nowadays. Nowadays, it is designed so that algorithms can pick up on every word spoken and react. So that's the markets we have to live in.
Well, we're going to clarify two things. So when you talk about Fed speakers, the different Fed members will go out, for folks who don't follow this that closely, and they'll give speeches before economic groups and things of this nature. And the media will listen very carefully for what they're saying about the economy and for hints about whether they think it's going too fast, it's going too slow, rates should rise, rates should fall. So that's what you're referring to. And just to clarify the dot plots, there are, as you say, I think 15 members on the committee.
I forget the exact number, because everyone, although not everyone's on the committee, not everyone has voting rights on the committee. Yes. Every year. I think everyone's included in the dot plot, so it's not exactly the same number. There's a few extra dots in there.
Well, they put a little dot by everyone. Well, they don't tell you the name of the person, but they put a little dot on what people think. Again, interest rates will be at the end of this year and the end of next year. And so you can see, well, 8 people think it's going to be, it really is a plot. 6 people think it's going to be that, and 4 people think it's going to be this or whatever. And they don't tell you the names of who it is, but you start to get a feeling for who may vote which way. If they think rates are going to be lower a year from now, that means they've got to vote to make the rate lower. And so it's, as you say, sort of a forecast. Again, they don't tell you the names of what every person thinks, but it's sort of a forecast of what the thinking is of the Fed. So just want to clarify.
And they do provide a median guidance. So they do try to provide for you what the core thought is in the group. And then you can listen to the Fed speakers and try to figure out for yourself, okay, these 2 or 3 people are more hawkish. This guy or this gal is more dovish, and they're probably that dot, or they might be that dot. And over time, you can kind of figure out who's who, except for the group in the middle.
Right. Let's also talk about the Federal Reserve Chairman's press conference, which we will cover here at Moomoo. That starts at 2:30 in the afternoon, New York time, on Wednesdays. It'll be 2:30 tomorrow, and it's about an hour long. The Fed chairman takes questions from the media. So, what should people be listening for? Investors be listening for in that speech or press conference, if they listen to it at all, that will give them things in their own market and investing journey? What should they be listening for?
Well, you're going to listen to Powell's thoughts. Now, he's going to try to represent the group, but his speech and his answers to questions are obviously colored by his own thoughts. You're going to listen to his thoughts on the future of the quantitative tightening program, on the future of short-term interest rates, on where he thinks the labor market is, on where he thinks inflation is going. And he'll try to wrap it up in a bow for you to give you an idea of what the Fed is going to do under what circumstances. Now, it gets confusing, but I think, and you're going to learn which reporters, as you listen to the press conference, as you listen to the question and answer session during the press conference, you will learn which reporters have earned their seat there and which reporters are just seem like they're coming out of left field because they're asking things that are really of no importance to anyone trying to make a living in the financial markets.
Great. Now, of course, what the Fed deals with is interest rates, and we tend to see reactions in bond yields, U.S. Treasury bond yields, such as the 10-year and the 2-year. But many of our listeners actually are interested in stocks more than bonds. Do stocks tend to move around with regard to FOMC meetings, or is this mostly more of a bond event? And how about things like indexes like the S&P 500 or the NASDAQ and things of this nature? Do they move around, or is this more of a bond investors event?
Almost certainly they will move around after the event. They will, of course, we have earnings this week, heavy earnings, so that can color things a little bit. But after the event, the late part of the afternoon on Wednesday and probably Thursday and Friday, you will see increased trading volumes, and it may be directional. You may see the market really move in one direction or the other based on how the Fed meeting was perceived by the investing public, by portfolio managers in general. And very good chance that the later part of this week will be quite active for stocks. Yeah, so bonds will move and stocks will they'll definitely be active and they'll probably move. And it's hard to predict which way.
That's great. That's great. I can remember a press conference, I think with Chairman Powell, where they made the statement, the stock market was fairly stable, and he said something that was perceived a certain way, and I believe it is all the indices very quickly dropped right after he made this statement. So it can be quite a significant move. All right, let's go to some questions, starting with some that we got in advance of this live event. The first one is from Dr. Pot 1. All right, what are some proactive strategies investors can employ to hedge against potential market disturbances, resulting from the Fed decisions? Are there particular sectors or assets that tend to perform well or poorly in the aftermath of interest rate announcement, and how can investors position themselves accordingly? Well, you can't give personalized investment information, but for each people or advice. But what are something that's typically happened that people might want to think about into and during Fed days?
Well, I know for a fact that some traders will reduce their overall exposure going into the event. So as you see a decrease in trading volume, you might actually see stocks trade off a little bit today. I don't know where they are now. Are they down? Maybe a little bit. And they might actually be some risk coming off the table the day before or the morning of. But generally speaking, it's rather quiet. A lot of folks try to play catch up or play with momentum afterwards. So yeah, markets move, but there's not a lot of things you can do other than what you would normally do in order to hedge yourself around these events. These are high profile events, and they often don't go as planned, because even if Powell is trying to send one message, there's a very good chance in the answering of a question that he says something that doesn't sound quite like the narrative he was trying to emit. So he might be trying to tell you, yeah, rate cuts are still on for later this year. But in the answering to a question from, say, somebody who's really smart, let's say like a Mike McKee from Bloomberg, like he's one of the smart guys in that room. Let's say he asks a question where Powell's caught off guard and he answers it honestly and says, you know what, if the economy keeps growing and inflation keeps rising, well, we may have to actually raise rates later this year. That might blow up the market, because that's not the narrative he's trying to send. So you do have to be ready for that. So I do understand why some folks reduce risk. I basically maintain my core positions and trade the levels that I have for those stocks as if the Fed wasn't happening this week, basically. But I won't go out on a limb. Let's say I almost every day I'll trade a couple of stocks just for the day. Not really part of my investment thesis. I probably will not do that tomorrow. I probably won't get myself extended.
All right. Well, here, our next question is from Mr. Cash Cow. All right. Interesting question. My question is, how can we better prepare ourselves for the effects of the rate changes, as the Fed, have been teasing us with rate cuts for a good while now? Of course, we don't know what's going to happen. Jerome Powell has said he may change his mind, but we are pretty much probably done raising rates, and he may change his mind. And the market's expectation is that sooner or later, the Fed's next move will be to cut rates. So again, we can't give customized advice, but let's say that proves to be true and the Fed does cut rates at some point in time. What typically happens, and what goes up, what goes down when that happens historically?
Well, this is a little tricky, because I think Chairman Powell made a mistake last November when he pivoted towards what seemed like a more aggressive rate cutting strategy going forward. because now, as we see, after what looked like pretty strong economic growth for the second half of 2023, 2024 is off to a slower start. But inflation is rekindling. Inflation is getting hotter again. So we're kind of in a catch-22 here, where he can't really rates as he said. So those odds are changing. We haven't seen that priced into the market yet. The market's still pricing rate cuts of, I don't know, maybe 2 to 3 rate cuts. I believe that's what the equity markets are priced for. But if you look at the futures market, there's not a 25 basis point rate cut priced in until it's about 50-50 for September, really until November. And that would be after the election. So they could go ahead with that rate cut in November because they can't really do anything the meeting or two before the election because they strive to be perceived as apolitical. And if they did anything, if they cut rates prior to the election too close to that election, they would be perceived as trying to help the president get reelected. If they did the opposite, they would be perceived as trying to help the former president get elected. So I think if they get past June without doing anything, they have to hold their horses until after the election. So this could be a very quiet year for the Fed, but they are going to change the messaging. I think they have to change the messaging this month. I believe that they have to reopen the possibility of a rate hike down the road. So a rate cut is no sure thing. A rate hike probably isn't realistic, but I think they have to put that back in the minds of investors. I think investors are ahead of the game on the rate cuts. And as Jamie Dimon told you, that's probably not where they should be positioned right now.
Well, let's say that
I probably didn't even answer your question.
No, we get a rate cut at some point in the future. What historically happens? What goes up? What goes down historically when rates go down? I mean, banks go down, right?
Well, remember the Fed only controls short. What's that?
Yes.
What was that, Sharon?
Oh, I mean, bank stocks typically will go down in a rate cut environment and up in a rate hike environment. Is that correct? Maybe I'm wrong.
Well, that depends. Yes. The Fed really only impacts the very shortest end of the curve when they target the Fed funds rate. The longer end of the curve still trades really in the free market, and that's impacted by things like debt levels and growth levels and things like that. So if there's a chance that the long end of the curve won't change that much, or maybe those yields will even go higher, the short end, even if you bring the short end in, that really would become more profitable for the banks. For the banks, you would then see a greater net interest margin. So that actually, and the lower short-term rates would probably make the banks more aggressive in marketing loans because now they have this wider margin. So that could, even a rate cutting environment, if it increases the spread between short-term and long-term rates, could be quite profitable for the banks. Whereas raising rates, which is thought of as something positive for the banks, they're only really raising the short end, which if the long end doesn't move, that narrows the spread. So it's never cut and dry that long-term rates are short, that raising or cutting rates would be profitable or less profitable for banks. It's really what you have to watch is the inversion between the spread between the long end and the short end of the curve. Right now it's an inversion, but you'll see that, say in 2023, spreads were much more deeply inverted, which should be a negative, but you still saw banks turn out some pretty nice profits because there was some return to investment banking, and they were able to force this onto some of the consumers, let's say mortgage consumers, even though Treasury long-term yields were not really reacting quite to the degree as what you saw with the short end, when the Fed was in the more aggressive rate hiking phase.
All right, great.
It's a very hard question to answer, to be honest.
That's what I do, but you can answer them, I'm sure. You're up to the task. Aaron 39 asks, as the Fed cuts interest rates, which it may or may not do, fixed income securities may not be as attractive. What are some alternatives that investors can consider? So let us say that fixed income, i.e. bonds, become a less attractive investment in terms of lower yields. I know you can't give specific recommendations, but what is something that investors might look at who then want a different yield or a better yield or what have you? What historically are some options there for them?
If I'm giving away the answer. If yields go lower, well, their main competitor is really dividend stocks. So that's good. That's solid for dividend paying stocks. So you might see utilities and some of the REITs do well in a lower interest rate environment because now they're competing with their proxies for bonds. If interest rates goes very low, if growth is very low, and that's why interest rates are low, well, that's very good for growth stocks. That's very good for tech stocks because they're still providing some return when the rest of the market, when the rest of the economy is having trouble doing so. So that's when all those high flyers, when they really, that's how we developed a FANG 4 and a Magnificent 7 because we were in a low growth environment. And really the only game in town became these specialized tech stocks that really became overweighted in our marketplace. But that was a result of everyone making the same trade.
All right, great. Next question is from a person with a number for an account, but is a two-part question right up Steve's alley. Question 1, what role does technical analysis play in an approach to trading around the Fed's announcement, and how does it complement fundamental analysis? Now, Steve writes a lot about technical analysis, so right up your alley. Any thoughts on that?
Well, I don't think that the potential for change monetary policy changes technical analysis all that much. You're still going to look for the same setups. You might see lesser or greater, depending on the change of policy, changes in your target prices based on those setups. Let's say you typically put a 20% premium on a cup of handle pattern. When you get that breakout, depending on the change on the way the market's evolving, you might change that to a 25% target or a 15% premium, because that's what I do basically. When I set a target price, I basically have an average for that sector for that setup. And if the average is 21%, I'll add 21%, and that's my target price. It's really that simple. And if it's not a good time for the markets, I'll drag that into 15 or 10%. So basically, your technical analysis is going to be the same. Your fundamental analysis, because the economy might be evolving, could change here, especially for different kinds of stocks. So I think it has more of an impact on fundamental analysis than it would on technical analysis, because technical analysis, although your end result, your target price or your panic point might change, it's always going to be the same setups, the same dojis if you're looking at individual days, or the same patterns if you're looking at a 6-month or year-long chart, something like that. So I don't think technical analysis impact that much. Fundamental analysis, or at least forward-looking fundamental analysis, might be. But basically, you play your game. If you're an investor, you stick with your core positions. You might want to evolve those or rebalance those based on the outcome of the meeting. But that really has nothing to do at the moment, at the specific time and place and time where the change is made in policy to either kind of analysis.
Great. All right. This may be our last question. We'll see if we can get one more in after this. I love Soya as asking. This is an excellent question. One of your favorite types of questions. Fed days have trading that is very volatile. Should we join in the trade or just stay on the sidelines? Always a good question. Just forget the whole thing and move on. What's your thoughts on that?
Well, it depends what kind of trader you are. If you are a swing trader or a momentum trader, well, do that. Be a swing trader, be a momentum trader. If you are an investor, then to catch your breath, see if this market is moving away from or toward your add points or your panic points or your target prices, and take advantage of moves towards those prices to take the steps that you had planned ahead of time, because every investor should have those targets and those panic spots set up ahead of time so that you've taken all the emotion out of the game. But if you're a trader, a pure trader, not an investor, if you're just someone who wakes up every day with a flat P&L and no positions, and you just go through the day making several trades trying to make a few bucks, well, then you're probably a swing trader or a momentum trader. So I would say this is your opportunity, because this provides an impetus for momentum, for a swing. So I think for that kind of trader, which I can do, but it's not my bread and butter. I think for that kind of trader, this is your day.
So just to use a couple of terms here, an investor is someone who buys a stock for a longer term period. A trader is someone who buys it for a short-term period because they see what they believe to be a short-term situation, versus an investor is a longer term situation. Is that correct?
Yeah, more or less. I mean, traders can be anything. You can be a day trader. You can be a minute trader. I mean, or you can be a trader who puts no time on things. You could trade over months. A trader can be anything, but a trader is someone who is more specifically targeting a monetary gain without thinking that much about the thesis behind the stock. You are sensitive to time, so it is more shorter term, but you're more interested just, I don't care if they make widgets. I don't care if they sell popsicles. This is how I see it technically. A trader is going to be more interested in the technicals. An investor is longer term, like you said, and they are going to be more interested in the fundamentals and the economics.
All right, great. Well, hopefully we have both of them watching you and getting great advice. We're going to leave it there. So, however, check Steve's column out every day, every trading day, to Invest with Sarge on the Moo community. Steve, we're going to have you back next week. Join us next week to discuss more about the markets. Ask Steve more questions. Steve, thanks for joining us, and best of luck trading, everyone. I'm Jerry Cronenberg. Thank you very much for watching. Have a great day.